Hi, welcome to the Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest tonnage updates in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to Crypto Republic. Bringing you updates every day at 9 a.m., noon, and 7 p.m. Eastern Standard Time. And here at the Crypto Republic, we give you the bird's eye view, a satellite perspective, to spot the big picture shifts while everyone else is stuck in the daily chaos. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Well, imagine this. The very banks that told crypto companies to follow the rules are now trying to block them from doing just that. Ripple applied for a national bank charter to comply, and yet the banks sent letters to regulators demanding they stop it. Why would they do that? And what does that mean for XRP, stablecoins, and trillions in potential market cap? Today, we're decoding the regulatory trap that just backfired, and the implications could reshape the entire crypto landscape. Ladies and gentlemen, if you've been following crypto news, you know there's been a chess game happening between banks and regulators and crypto innovators. But today, we're going beyond the headlines, and we're breaking down why the American Bankers Association lobbying may have actually triggered the opposite outcome they wanted, and why Ripple and XRP are right at the center of this story. Here's the big question. Can traditional banks really block crypto innovation, or have they just accelerated it without realizing? I just want to stop and thank everybody that takes the time to like, subscribe, and comment and share these videos. These bunch of things really do help out the channel very much. And if you're new here, just know that at the end of the videos, we have one of the epic ramps that everybody has really started to really like. So our videos are broken into two pieces. And with that being said, let's dissect this. To understand what's happening, we need to zoom out. Let's go back to the 1990s. The internet was considered a niche technology. Banks resisted online banking, fearing deposit flight and a lost revenue. Fast forward to today, and the same pattern is repeating. But now the technology is crypto and stablecoins. Every new innovation threatens the existing banking moat. Think of the telegraph transforming markets in the 1800s, or electronic trading in the 1970s. Those who adopted early gained enormous advantages, while those who resisted fell behind. Crypto is today's telegraph moment. Fast, programmable, and borderless money. Ripple, through XRP and RLUSD, is at the forefront of this transformation. Now, let's focus on the American Bankers Association, or ABA. They've argued for a long time, if crypto companies want to operate like banks, they must follow bank rules. On the surface, that seems reasonable. But here's the twist. When Ripple actually applied for a national bank charter, following the exact ABA demanded rules, the ABA suddenly sent letters to regulators asking them to block or delay the process. That's a documented contradiction, ladies and gentlemen. Why would they do that? Banks fear losing deposits. ABA warns that stablecoin yields of 2 to 4% could trigger a mass migration from traditional bank accounts. Their models suggest as much as 2 to 2.2 trillion could leave the banking lending base if the stablecoin market scales to 3 trillion by 2030. Let that sink in. These numbers are massive. But here is where it gets interesting. The same yield mechanics already exist through MasterCard's crypto rewards program. Consumers can earn 1 to 4% back in crypto through traditional banking rails, and the ABA has said nothing. Why the double standard, you might ask? That's the question we'll answer today. Let's talk about Ripple's RLUSD stablecoin for a second. It's fully compliant, dollar-backed, and backed by U.S. Treasury instruments. That means every dollar flowing into RLUSD translates into a dollar of U.S. government debt purchase. In other words, stablecoins are directly supporting the Treasury, while the ABA is lobbying to block the very infrastructure that benefits the government. The White House, through crypto advisor Patrick Wick, has openly called out ABA's concerns as overstated. The Treasury itself projects that stablecoin market could grow to 3 trillion by 2030, showing institutional support for this growth. The executive branch has effectively chosen a side, and it's not the banking lobby. Let's look at regulators now. Let's talk about the CFTC and the SEC. Historically, the SEC and CFTC often compete over jurisdiction in crypto. That uncertainty delayed institutional adoption. Compliance teams would wait for clarity before moving billions in capital. That's changed. The SEC and CFTC have signed a memorandum of understanding, joint reviews, shared information, and substituted compliance. That means when the Clarity Act passes, institutional flows can activate immediately, not months later. So imagine trillions ready to move as soon as the regulatory green light is given. XRP corridors, RLUSD settlements, and on-chain liquidity all activating simultaneously. Let this sink in. You got to marinate on this. This is huge. This is a coordination event rarely seen in financial history. But here's the contradiction that exposes the ABA strategy. On one hand, they demand crypto companies follow bank rules. On the other, they block the charter applications that allow that compliance. And then they warn that stablecoin yields could trigger deposit flight, even though years of data show no effect. This isn't about principle. It's about protecting incumbent bank revenue and defending a competitive moat. The lobbying isn't designed to regulate fairly. It's designed to prevent decentralized infrastructure from disrupting traditional fee-based systems. You got to let this in. This is everything. This is really what's going on, the nuts and bolts. So the ABA created a regulatory trap, and it backfired. Think of early derivatives markets or electronic trading for a second, okay? Think of this. Regulators feared disruption at first, but once frameworks caught up, adoption exploded. Crypto and XRP may be at the same tipping point, delayed by resistance, but inevitably once the regulatory machine is fully operational. I want to talk about institutional market implications. Institutional capital is posed to flow, ETF inflows, bank allocations, and treasury-aligned stablecoin infrastructure all signal that adoption is imminent. RLUSD's compliance aligns directly with U.S. fiscal mechanics. The ABA can send letters, but the math doesn't lie. Institutional capital is waiting, and it's aligned with the executive branch. If you were an institutional investor, would you wait for regulatory clarity or act as soon as these structures are in place? Let me know your thoughts in the comments below, because that's the crux of this. Looking ahead, the regulatory landscape is becoming clearer. The Clarity Act's summer legislation window is confirmed, so lawmakers are ready to move forward. Ripple's national bank charter is still alive and active, keeping them on the path to compliance. Meanwhile, the SEC and CFTC have operationalized joint compliance measures, eliminating the uncertainty that often slowed institutional adoption. With these pieces in place, Ripple and XRP are positioned to benefit from coordinated activation across payment corridors and stablecoin infrastructure, a scenario that could accelerate adoption faster than most expect. So here's the takeaway, ladies and gentlemen. The ABA's regulatory trap backfired. Their letters and warnings tried to slow crypto adoption, but in doing so, they highlighted the advantages of compliant stablecoin networks and XRP settlement corridors. Treasury, the White House, and regulatory agencies are aligned in favor of this innovation. Institutional capital is ready, compliance pathways are operational, and the stage is set for a major adoption wave. The question now isn't whether Ripple and XRP survive regulatory pressure. It's how quickly the ecosystem will scale. Could this be the tipping point for crypto infrastructure adoption in the U.S.? Share your thoughts in the comments below. And if you want updates on every regulatory move in institutional flow, hit subscribe because the story is just beginning. Well, happy Saturday, ladies and gentlemen. Hope everyone's doing well. So much to talk about right now. Just like we had said in the last two videos that we thought Carg Island would get hit, it got hit. Thank you for all the members of the Wolf Pack that pointed that out. I want to welcome all the new members of the Crypto Monthly Desk in our Patreon, all the new members of the membership channel, and all the new subscribers. And if you made it to this point, I appreciate a subscribe and a like because you're here and you want to learn. Format is you're going to have to go back a couple videos because these rants at the end, the Italian ice of the candy, are here. And a lot of people come for this. And where we go off and we just say it how it is. So with that, before I break everything down, with that being hit, and with Marines on the way, a lot of game-changing things is coming right now. If I look at right now, XRP is at like $1.39 of recording. Again, Operation Printed to Win. It's coming, ladies and gentlemen. It's coming. Again. So let's break this down. I want to talk about global macro oil surges for a second, okay? And financial strain. Rising oil prices are tightening financial conditions worldwide, swiftly eroding expectations for the near-term Federal Reserve rate cuts. This scenario mirrors the 2007-2008 oil spike that preceded the global financial crisis. The primary threat to equities is likely deteriorating corporate earnings rather than inflation itself, particularly if the ongoing stress in the banking sector limits credit availability and weakens the connection between broader Wall Street and broader economy. Ladies and gentlemen, I tell you, as financial mercenaries, we don't really care what happens. Again, as the remora, we don't get cut up like sushi. We feast on the chum that is served up to us on a plate. Because when you see the narrative, what's happening, it's very hard not to take advantage of this. It becomes a story. It's like watching a sports game. As demented as that might sound, it does, and you can play the levels. Again, it's I don't really care what happens as long as we prosper from it. The people that retain us, again, as long as we prosper from this. And when there's more scenarios to take advantage of, it's even better. So getting back to that, right? Again, markets are approaching levels that are especially sensitive to policy intervention. Oil surpassing 100 per dollar, the dollar climbing above $100, and long-term yields exceeding 5%. Breaching these thresholds could prompt governments or centralized banks to act to stabilize growth and financial conditions. So under the base case, oil price spikes eventually subsiding, benefiting treasuries, China-focused equities, consumer sectors, and small-cap stocks. However, prolonged geopolitical conflict or significant financial shock could tip the global economy towards stagflation. We're watching that. Looking at the overall market, Bank of America and some other banks have revised its oil and gas forecasts higher, citing the risk of extended disruptions in the Strait of Hormuz. That could tighten global energy supply and keep prices elevated through 2026. In the base scenario, Brent crude averages roughly 77.50 cents per barrel next year, but sustained conflicts could push prices significantly higher depending on supply losses. So higher commodity prices dramatically boost free cash flow for European oil majors, turning previous deficits into substantial surplus and strengthening balance sheets. While fundamentals have improved, BOFA notes that some energy stocks may be overvalued due to short-term price energies and price spikes. Ladies and gentlemen, with what's happening and changing, it's very hard to put your thumb on this, right? Because again, that island could be taken over and Marines could land on that and take that over, and basically that ends the war. Maybe that becomes like some form of like some Guantanamo Bay or something, and you take 90% of the oil market away from Iran, and what do they have left? You're just taking the oil away from China. So you could just occupy the island, and what are they going to do? Honestly, at the end of the day, I know that's a crazy way of looking at it, but the market's not priced into that because no other administration, POTUS right here is on a mission to do what he needs to do, that he feels he's right to do what he's doing. We're not here to ever disseminate facts. We're here to disseminate facts so that we can prosper. None of this is financial advice. But that's a game changer in the energy markets right then and there. It really, really is. So watching where things may open on Sunday night, this stuff could be on a tear going higher. We got to see what's going to happen again. But, there's a lot happening. If you look at gold's role in geopolitical tensions, according to UBS, gold typically rallies at the onset of conflicts. Though its performance throughout the wars is inconsistent, early gains often reverse as interest rates rise over tension eases. Oil serves as a more immediate hedge against geopolitical disruptions, whereas gold value lies in shielding portfolios from monetary consequences of conflicts such as declining real interest rates, currency debasement, and mounting government debt. UBS maintains a bullish outlook. They're still looking for gold to be between $5,900 and $6,200 per ounce by the end of the year, supported by persistent debt concerns, geopolitical uncertainty, and trends towards de-dollarization. Again, we're trying to take the PhD out of this for everybody who's new here and all of our Wolfpack members. So, if you different banks and different, I always taught to look at them as like sports teams, excel at different things, right? And you come to basically lean on some of them more than others for what they're doing and why. This is very, very important. So if you look at JP Morgan, they're big in the physical markets, okay? So they're looking at physical oil constraints. So the oil market is now facing a tangible supply shock. Tanker traffic has collapsed and production shut-ins have reached around 6.5 million barrels per day. This is very important, potentially rising towards 12 MBD if the disruptions continue. The problem is not falling demand, but shortages of refined products, including diesel, jet fuel, LNG, and naphtha, due to stalled exports from the Gulf. The Strait of Hormuz typically carries around about 5 MBD of refined products, leaving Europe and Asia particularly exposed. So fuel prices and refining margins are surging. If you look at what's being the products refined, that's where the shortages are. Again, there's so much to take advantage of with this. And again, we're taking advantage of every situation that this situation is creating. The downstream alpha harvesting scenarios that we're taking advantage. Again, ladies and gentlemen, one tips from the pit pays for your entire year. So if you want to see how we're helping people change their life, do join the Crypto Republic desk monthly. One tips from the pit pays for everything the entire year, and you learn what a financial mercenary is seeing and why, and how we're going to take advantage of the shortages that are not going to be fixed any day soon. Oil may stabilize, but the problems downstream from nothing being shipped down, that's massive. LNG, sulfur, all the things that we go over all the time. We're talking about nickel in Indonesia, talking about copper processing in Northern Africa, sulfuric acid shortages. There's so many ways to take advantage of what's happening right now. It's as upsetting as everything is, it's our duty as financial mercenaries to take advantage of every opportunity, because we can't navigate this storm, ladies and gentlemen. We can't. We can't navigate this. All we can do is sail through it and better our own situation, what's happening. Again, that's why we're the remora. So keep staying with me. Follow with me. Governments across Asia are responding with emergency measures. We went over this, including rationing, subsidized export restrictions, and release strategic reserves. We go back to Carg Island, Iran's export vulnerability. We went over this. Hat tip to the members of the Wolfpack that pointed it out when we said this about 48 hours before this happened and what was happening. Again, it's these tidbits of information, ladies and gentlemen, why people retain us. It's these factoids to know 72 hours, a week in advance, to position, to take advantage of what may happen. We want to always be ex ante before the fact. We got to be before the fact. That's why. Knowledge and intel is free. It's how you apply that. But that's why people retain us, and people are joining the Crypto Desk monthly to understand this and take advantage. Again, if you're still here, why haven't you signed up? Disruptions to Iranian supply could remove as much as 3.5 million barrels per day from global markets, significantly tightening availability. Carg Island serves as the hub of Iran oil export infrastructure, and would disrupt their effectively incapacitate. So if we disrupt that, we incapacitate the country's crude oil exports. Let that sink in. Disrupting them would effectively incapacitate the country's crude exports. Again, we think that the island's going to be occupied as far as we're concerned, and that's an off-ramp for the end of this war. You occupy the island, you've taken over the crown jewels of that country. You don't need to take over anything else. Now you control the oil. And it becomes a giant naval base. Even partial supply losses could drive oil prices sharply higher given limited spare capacity elsewhere. The reports of geopolitical risk premiums in oil throughout the street could rise substantially if infrastructure around the Carg Island and Nippon Shear routes comes under threat. What that means is everybody around is now pricing this instability in, because something's about to happen that was never priced in. Listen, you had people that advised the first Bush to do this, the second Bush to do this, but no one ever did for different reasons. This is going to be used as leverage. And again, I'm in the camp that believes the island's occupied and becomes a naval base, and we control the oil. The States controls the oil. It's almost like the United States is causing the chaos there now. That, if you want my opinion, if you look at it like that, none of this is financial advice, just our opinion. But that's what it is. So no one really can price in the fluctuations of what's going to happen with oil. But again, it leads to the most delicious, frosty morsels and beverages to take advantage of in financial instruments because of this. This is a once-in-a-lifetime situation, because printed to win it, Operation Printed to Win, it's coming, baby. Don't miss out. If you want to look at gold fundamentals, gold's recent rally reflects geopolitical uncertainty. In our opinion, central bank purchases and declining real interest rates, reinforcing its role as a strategic reserve asset. Central banks, particularly in emerging markets, continue to accumulate gold as part of a broader strategic strategy to diversify reserves away from traditional currencies. So if you look at investment demands remains robust despite rising prices, supported by ongoing macroeconomic uncertainty and long-term concerns about geopolitical and geo-debt and monetary stability. Most banks on the street expect structural support for gold to persist, with continued official sector demand and macro risk maintaining elevated price levels over time. What this means in English, ladies and gentlemen, is people and macro traders. I told you in some of our other videos, people, if you're you got to make your weekly numbers, your monthly numbers, your quarterly numbers. Depending on what prop desk you're running, it's easier to trade oil right now than it is anything else, because it's just flowing. Again, so as money flows from the risk off, because I got to believe that oil opens higher, in our opinion, right? After I make this video, I got to be on the phones because of things that we're walking. But we're watching downstream markets from here. Again, we're watching nickel. We're watching copper. We're also watching mining companies in different geographic areas. Indonesia, copper in certain northern African countries that are basically going to have issues when they don't have enough sulfur. If you don't have sulfuric acid, you can't leach. Leaching is is something that you use to refine certain things out of ore. Again, if you don't have a smelter that makes it as a byproduct, you're on the hook having to buy that. We've been selling over sulfuric acid. It's like a bonanza. I'm getting phone calls from people that they just need it. That's where the true alpha is, the easy pickings from over there. Again, it's so easy being a financial mercenary right now. You got to love it. It's upsetting, but at the same point in time, I want to break this down for you again. Surging oil prices are tightening global financial conditions and rapidly removing expectations for near-term Fed rate cuts. It's creating a macro backdrop similar to the 2007-2008 spike preceding the financial crisis. The larger risk is to equities, is earnings deterioration rather than inflation. Let that sink in. It's very important, especially if stress in the banking sector restricts credit and weakens the link between Wall Street and the real economy. Markets are approaching key sensitive levels, oil above $100. Above 100, long yields above 5%, which could trigger government or central bank responses aimed at stabilization, growth, and financial conditions. It's very important. Cause and effect, very important. The base case assumes oil spikes eventually fade, favoring treasuries, China consumer sectors, and small caps. But a prolonged conflict or financial shock could push the global economy into stagflation scenario. Bank of America raises oil and gas prices forecast due to rise of prolonged disruption in Strait of Hormuz, which could tighten energy in a base case. If you look at this, they're looking at Brent averages 77.5, but extended conflict scenarios push the price higher, depending on that. Higher commodity prices dramatically increase free cash flow for European big oils, turning prior deficits into large surpluses and strengthening balance sheets. So if you remove all this, you have a lot of different scenarios. Again, so this is what you see a lot of these things overall. And I am shocked that I'm shocked, but not shocked by what's happening as well. Why I'm not shocked is because they need a way to end this scenario again. So to me, this play that they just did overnight is something else and on a next level of tradecraft. But let me start with something very important. The market right now is reacting to headlines, not reality. And when markets trade on headlines instead of logistics, that's when the biggest pricing errors happen. Recently, we saw markets rally after comments by POTUS in a televised interview where he suggested that the war was essentially finished and the opposing side had lost its operational capability. Markets love simple narratives like that. Algorithms especially love that. So important, ladies and gentlemen. A single headline that suggests war is almost over can trigger billions of dollars in automated buying, but institutional capital cannot operate that way. Professional allocation is not based on interviews or press statements. It's not. It's based on logistics, supply chain infrastructure, and math. When you examine the hard data behind this conflict, the situation looks very different from the narrative currently priced into markets. The central issue here revolves around the world's most critical choke point, the Strait of Hormuz. The narrow waterway handles roughly one-fifth of the world's oil supply moving through global markets. In normal conditions, somewhere between 16 and 18 billion barrels of crude per day go through there. They transit through this corridor. This is not just a shipping route. It's the main artery of the modern industrial economy. That artery becomes disrupted, even temporarily, the entire global pricing system for energy begins to fracture. And that is exactly the risk scenario currently being ignored. So when analysts talk about rerouting supply chains around the Strait of Hormuz, the assumption sounds reasonable on the surface, but when you quantify the physical infrastructure and availability, the math simply does not work. Again, Saudi Arabia's east-west pipeline cannot move roughly 5 million barrels per day towards the Red Sea. The Hasban-Fajr pipeline in the UAE adds roughly 2 million barrels per day. Even if we include unconventional tanker routes, some gray market shipping activity, the total bypass capacity sits somewhere around 5 to 6 million barrels per day. Now compare that to the 15 to 18 million barrels that normally pass through the strait. That means more than 60% of the region's energy supply cannot physically bypass the choke point. Not economically, not logistically, not mathematically. This is why energy markets are far more fragile than current pricing suggests. But crude oil is only one part of the story. Liquefied natural gas is another critical piece. Around 20% of the global seaborne LNG originates from Qatar's massive export infrastructure centered around Ras Laffan. Any disruption there has immediate ripple effects across Asia and Europe, where LNG imports are essentially lower for power generation. Europe is particularly vulnerable. We went over those in tips from the pits while we said that's what the disruption of everything we're talking about right there. Since the energy shock triggered by the Russian invasion of Ukraine in 2022, Europe has shifted heavily towards LNG imports to replace lost pipeline gas. But the strategy creates a different kind of dependency. Instead of pipelines, Europe now depends on ships, and ships depend on a safe sea lanes. Those sea lanes become dangerous or congested, the cost of energy rises dramatically. Right now, we're already seeing early signs of this in freight markets. Very large crude carrier rates, VLCCs, moving oil from the Gulf towards Asia, have spiked dramatically. I mean, I'm looking at it right here. They're off the charts. Some routes have seen charters approaching $450,000 per day. That kind of price spike does not happen during normal shipping cycles. It happens when the market suddenly realizes that the global fleet capacity has effectively shrunk. Let this sink in. This is so huge, and this is what we're taking advantage of. I can't believe I'm giving this away for free, but how to apply this in another trade craft. But this right here is delicious. This is gold right here, gold. And this brings us to an extremely important dynamic in shipping economics. When vessels are forced to reroute around dangerous zones, travel times increase. We already saw this phenomenon in the Red Sea disruptions caused by attacks on commercial shipping routes beginning in 2023. Traffic through the Suez Canal dropped sharply as carriers began diverting vessels around the Cape of Good Hope. So important. That rerouting adds 1 to 2 weeks to a typical voyage. Now imagine that effect applied across multiple shipping lanes simultaneously. Ships spending extra days at sea means fewer ships available to move cargo. In English, ladies and gentlemen, in other words, global shipping supply shrinks even if the number of ships stays the same. And when the supply shrinks in logistics, prices explode. This is why shipping companies, port operators, and maritime infrastructure owners suddenly become some of the most valuable assets in the global economy during the periods of geopolitical stress. Remember, I said everything else is old news? What I just said is what we're focusing on now. This is what's next. This sector is next. And when you combine all these sectors that we go through for the last 4 or 5 videos, and if you write this stuff down and you find the best plays that we're finding from this, it's very hard not to take advantage of the chaos that's happening right now. I'm talking about capitalizing off of the chaos, ladies and gentlemen. 1 tips from the pits. You capitalize off this chaos, you pay for your entire monthly and yearly subscription. They're not transport companies, ladies and gentlemen. They become economic toll booths. Another overlooked consequence of shipping disruptions involves agricultural inputs, fertilizers, especially urea and sulfur products, move in large quantities through Gulf shipping routes. Roughly 16 to 18% of global exports originate from this region. It's massive. Keep going over this, my favorite. Those shipments slow down or stop. The effect eventually reaches farmers. And when farmers face higher fertilizer prices, global food prices tend to follow. That's why energy shocks frequently evolve into broader inflation shocks. Energy is affected. Transportation. Transportation affects food. Let that sink in. Food affects everything. This brings us to the inflation question. One of the most surprising things about current market pricing is how calm inflation expectations remain. Forward inflation swaps in the United States are still hovering slightly above 2% inflation target. That's massive. So in other words, markets are behaving as though this conflict would have minimal long-term economic impact. I don't agree with that. None of us agree with that in our capacity, and that's not financial advice. Historically, ladies and gentlemen, that assumption has often been wrong. During the 1973 oil crisis and the 1979 Iranian Revolution, oil shocks produced persistent inflationary waves that lasted years rather than months. Today's global economy is even more energy intensive. You need energy for everything, and interconnected than it was during those periods. So the idea that a major energy disruption could occur without a meaningful inflation consequence is extremely questionable. Another important factor, ladies and gentlemen, involves central bank policy. For the past several years, markets have been obsessed with the idea of a pivot, the belief that central banks would soon begin cutting interest rates. But a supply chain-driven inflation shock, while I'm doing this, it's shocking, changes the equation completely. Everything is being ripped out, including the kitchen sink. What's happening right now? Things are being rewired, rewritten. When inflation is caused by strong consumer demand, central banks can cool the economy by rising rates. But when inflation is caused by energy shortages, rate cuts don't fix the problem. Lower interest rates do not create oil. I repeat, lower interest rates do not create oil. Let that sink in. They do not open shipping lanes, ladies and gentlemen. They do not reopen shipping lanes. They do not produce LNG. This is why energy shocks historically create stagflation environments, periods, where inflation remains high while economic growth slows. So for investors, stagflation is one of the most challenging macro environments. Stocks struggle because costs rise. Bonds struggle because inflation erodes real returns. And that forces capital to migrate towards real assets, energy, infrastructure, physical resources. Those assets benefit from scarcity. And in our opinion, cryptocurrencies. We like cryptos. It's a real asset. But that's again. Another major variable in this conflict is political endurance. Wars rarely end when markets expect them to end. Historically, history shows that conflicts often expand or persist during domestic political pressures. We saw this dynamic during the first Iraq War following the famous Mission Accomplished speech by George W. Bush. What was expected to be a short conflict ultimately lasts years. I'm sorry, during the second Iraq War. I apologize. Misquote. The lesson here is not about politics, it's about probability. Markets frequently underestimate the duration of geopolitical crises, and when duration expectations change, asset prices can move dramatically. This is also a technological asymmetric developing in modern warfare that affects economic calculations. Advanced missile defenses systems are extremely expensive. Intercepting drones or short-range missiles can cost hundreds of thousands or even millions of dollars per inception. Meanwhile, the drones themselves may cost only a few $1,000s. That's a sick ratio when you look at that. The price differential is crazy. The cost imbalance creates an unsustainable attrition model over long time horizons. So when governments face rising defense expenditures during an energy shock, fiscal pressures increase dramatically. That brings us to currencies. During periods of global stress, capital typically flows towards reserve currencies and safe havens. Assets. So historically, the primary beneficiary has been the U.S. dollar. Pattern emerged clearly during the 2022 energy crisis when investors rushed into dollar-denominated assets. A stronger dollar tends to amplify economic stress in countries dependent on imported energy, and Europe fits that description. European economies rely heavily on imported fuels and seaborne LNG. If shipping costs remain elevated and energy prices rise further, Europe could face a significant terms of trade shock. That's one reason why currency volatility may remain elevated throughout this crisis. Finally, there's one overreaching theme connecting all of these dots and dynamics. Scarcity. In a stable, globalized world, efficiency is the dominant economic principle. But in a fragmented geopolitical world, security replaces efficiency. Countries begin prioritizing domestic supply chains, energy independence, food security, logistics resilience. Assets tied to those themes tend to gain value when global trade becomes more uncertain. So the real question for investors in 2026 is not whether markets will be volatile. Volatility is here, ladies and gentlemen. It's already here. The real question is whether markets are accurately pricing the duration of structural impact of this energy shock. So right now, the evidence suggests they're not, which means the next phase of this crisis may not be driven by headlines or political speeches. It will be driven by something much more powerful, physical supply. And in a world where physical supply becomes constrained, the asset that controls the supply, energy infrastructure, shipping networks, critical resources become the foundation of global economy. Write that down. We're going over this in tips on the pits. Understanding the shift may be the most important investments inside of this entire cycle. I went over a lot there, ladies and gentlemen. You're going to have to rewind all that. I'm trying to take the PhD out of PhD. And listen to me. Why Operation Printed to Win It's coming is when you have the world changing and everything, I'm doing this, everything's getting ripped out, including the kitchen sink. Everything's being rewired, rewritten, right? Again, from our vantage point and what we see and what I'm looking at day in, day out, and what we look at globally, the world is changing. XRP, HBAR, ICP are going to benefit massively from this. XLM, massively from this. Again, the world is changing. And I always tell you to pay attention to what's quiet before it's loud. So with this whole scenario, we believe Sunday oil is going to have a real rip-your-face-off rally. But it's the supply shock where you can't get it. So just because they open it up, you got to bring it through. And what we're looking at this, again, even if we do occupy, the military does occupy the island, you got to turn everything on, right? Then you got to turn the refineries back on, right? then you got to have the ships going through this. So there's a lag time, and there's going to be a shock to the prices no matter what. If you're still here, I appreciate a like. And again, if you want to see how we translate into this, come and join the Crypto Desk Monthly. Again, one tips from the pit from what we're talking about pays for your entire year subscription, and you're learning, most importantly, to take advantage of this. So instead of looking at these psycho headlines that you see every day, learn to capitalize off of this. This is once-in-a-lifetime things that we're seeing here right now. Once in a lifetime. And again, the scorecard is not through YouTube videos. The scorecard is through your bank account, your trading account, your knowledge, your tradecraft of learning to take advantage of these themes, because these themes that we're teaching and we're taking advantage for our families, they go on forever. Just because when this is in the rear view, right, and you're like, yo, I'm not paying attention to this anymore, you learned how to trade all the spaces and sectors. You learned it. You can't unlearn something. But again, every day we see progress. And again, we believe the crypto market, when Operation Printed to Win it begins, baby. When that begins, what's going to happen in the crypto market is going to be unbelievable. The rip your face off rally is coming. Will you be there? Have a blessed day. I love you all. This content is for informational and entertainment purposes only and should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions always. Remember, the game is changing, and those who understand it first will benefit. Make sure you're on the right side of it. You have two choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves they'll never let it happen again, or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet, right up until the moment they're not. And this is one of those moments. Do not blink, because the world is distracting you with noise while XRP continues developing behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. This is not the end of the story. This is just the beginning. Just open your eyes, smash that like button, ring that bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to the Crypto Republic. We break down the global banking trends, giving you digital assets today, shaping the world, giving you context. We break down the major global banking trends shaping digital assets today, giving you context, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the Republic. Love you all.